Hey guys, welcome back to the channel. I'm Luke. Today we're going to be introducing debt and equity. So debt and equity is one of the core topics which comes up time and time again within the corporate issuers section of the level 1 material. So yeah, let's get into it. Okay, so today we're just going to introduce debt and equity as a concept. They're obviously key elements of the right hand side of the balance sheet. We're going to look at how they interact with the income statement. So debt and equity is effectively how companies finance their operations. They use a blend of debt and equity to fund the purchase of the assets which are used productively to generate revenue, which flows through to profit for the business. So how a company finances its operations is basically how it blends debt and equity on its balance sheet. So the cash that is raised using debt and equity financing used to purchase assets which are relevant to their chosen business strategy. So yeah, companies raise debt and equity financing. The cash that comes from the debt and equity financing they raise is used to purchase productive assets. It could be purchasing machinery, which are used to produce t-shirts. It could be to purchase real estate, which is used to generate an income for the business. There's loads of different ways that companies can use the cash that is funded from debt and equity. But regardless, the debt and equity cash proceeds are used to purchase assets which can fund the activities of the business. So those assets will be used to generate revenue and profit for the business. Okay, so before we define these two balance sheet items, debt and equity, in greater detail, I've pulled together a very quick, simple balance sheet on the right-hand side of the slide, which provides a high-level overview as to how the assets of a company are financed using debt and equity. So in this example, I've really simplified the asset side down to cash, short-term assets, and long-term assets. So cumulatively, or in aggregate, that will equal your total assets on the left-hand side of the balance sheet. And then these assets are financed using debt and equity. So I've split that into short-term debt, long-term debt, and equity. And that in aggregate equals the financing. So companies raise financing using debt or equity, and the cash that's raised from those sources of financing is used to purchase the long-term assets, the short-term assets of the business, and also there's some cash retained on the balance sheet for liquidity purposes. And what's really important to note at this stage, again, we'll cover this more in the financial accounting part of the syllabus, but the accounting equation needs to always hold. So your assets always equal your sources of financing. So assets equal equity plus liabilities. And that is called the accounting equation, and it must always hold. The asset side of the balance sheet must always equal the financing side of the balance sheet. So assets should always equal your liabilities plus your equity. So the value of your assets must equal the value of the financing raised to purchase those assets. So that's a very simple balance sheet. You've got your assets on the left-hand side and your sources of financing on the right-hand side. So you have your balance sheet. We understand how assets are purchased using debt and equity, but how does that flow through to the income statement of the business? So the assets that are purchased will generate revenue and profit for the business. So I've got what looks like quite a complicated illustration in the bottom right-hand side of the slide, but I'll walk you through this. So the debt and equity is used to fund the initial purchase of the assets. So we've got our assets. Those assets are used productively to generate revenue, and that revenue generated will create operating profit. Operating profit is basically what you have once the cost of goods sold and staff costs have been paid. So you have your revenue here. Once you've paid your suppliers and you've produced your inventory and you've paid your employees, their staff salaries, their wages, their bonuses, then you have your operating profit. And then the operating profit will be used to pay interest to the providers of debt capital. So the lenders who provide capital to the business will be paid next. So the interest is paid out of the operating profit. And then once the lenders have been paid, the government are paid. So you pay your taxes, and then whatever remains after your lenders and taxes have been paid is your net income or your profit. So your profit after tax, your net income, it's called a whole host of things, but basically your profit after all the providers of capital, the government, the suppliers, the employees, once they've all been paid, the profit that's available is either paid as a dividend to shareholders, so a proportion of that profit will be paid to shareholders as a dividend or a distribution, and what remains after that dividend has been paid is called retained earnings. And these retained earnings are reinvested in the business in more assets. So more assets are purchased using those retained earnings. And these assets will generate more revenue, and then the cycle repeats. So we go back through step 1, step 2, step 3, step 4, step 5, again and again and again, over and over again. And providing the business is generating excess profit, which can be reinvested back in the business, then this cycle repeats. We purchase more assets, those assets will generate revenue, will generate more profit, and the company will grow. And that all starts from that initial debt and equity financing. So that initial financing that comes from debt and equity providers is used to purchase assets, and then those assets will generate profit, and the profit will be reinvested. And look, this cycle can be sped up, right? We can have additional equity and additional debt injected. Even if the business is profitable and generating retained earnings that can be reinvested, the company can raise additional debt, raise additional equity, and the growth is accelerated. The business's growth is accelerated, it will grow faster and will generate more and more profit, and then shareholder value will gradually increase over time. And one thing to notice is that how the company is funded, i.e. the mixture of debt and equity on the right hand side of the balance sheet, will determine how much operating profit is due to the lenders in the form of interest, and how much will be due to shareholders in the form of dividends. So the more debt you've got in the firm's capital structure, the more profit will go to lenders in the form of interest payments, and therefore less profit will be available to shareholders in the form of dividends. However, if you have more equity in your capital structure, the less profit will go to lenders and the more will go to shareholders in the form of dividends. So the capital structure of the firm really matters, because the more debt you have, the less profit will be coming through to shareholders, because you'll have greater interest payments, which will mean more operating profit goes to the lenders and there's less residual profit left over that can go to the shareholders. So basically the point of all of this is that your capital structure really matters. It can dictate how much profit and how much dividends shareholders can take from the business. The more leveraged you are, the more profit needs to go to lenders to service the debt. And then finally, this is how I look at it. This is how I looked at it in the exam. This is how it all made sense to me. When you're looking at an income statement, what an income statement is effectively telling us is how much revenue is split between all the different stakeholders of a company. So you start at your revenue line, and then whatever sits below revenue is basically what is going to all the stakeholders in the company: suppliers, employees, lenders, and governments. And whatever residual profits are left, either distributed to shareholders as a dividend or retained within the business to purchase more assets and help the company grow and generate more revenue for next year. So again, visualize the income statement. You have your revenue line. Below that, you have your cost of goods sold, which is what is paid out to suppliers who help provide the raw materials to produce the product. Then you have your staff salaries, the bonuses. So that's what you're paying to your employees, and you need your employees to help produce your goods and services and market and sell your goods and services. Then you get to your operating profit. Below your operating profit is your interest expense. So that's your cost of debt So that's what you're paying to your lenders who are providing the debt capital, which helps support the purchase of assets. And then finally, you'll have your income tax expense line, which is how much you're paying to the government in the form of taxes. And the government are providing public services and resources that benefits the business. So there's a payment that needs to be made to the government in the form of taxes. And then after that, you have your net income or your profit after tax, which is what is due to the shareholders after all other costs and payments have been made. So that's a very brief introduction to debt and equity. Hopefully that made sense. Any questions, feel free to fire them off in the comments, and I'll see you guys in the next video.